All right, welcome to this explainer. As an advisor who spends honestly a whole lot of time evaluating corporate risk and long-term value, I am absolutely thrilled to guide you through today's briefing. We're going to be looking at how managerial accounting has evolved far, far beyond basic bookkeeping. It's actually become the ultimate tool for implementing long-term sustainability strategies. We're going to cover the whole shebang, from top-tier corporate strategy and stakeholder engagement, right down to the granular level of lean manufacturing and modern accounting practices on the factory floor.
Okay, let's dive right into this with a number that should be a massive wake-up call. Take a look at this, 90%. Back in 1955, the world's 500 biggest companies appeared on the very first list of the Fortune 500. Well, today, only 10% of those original companies remain in business. That means a staggering 90% of those original powerhouse companies have completely failed. Why? Simply because they failed to manage their risks successfully in a rapidly changing world. As you'll see, strategic longevity isn't just guaranteed, it's engineered. So here is our strategic itinerary for today. First up, the corporate longevity crisis. Second, the business sustainability cycle. Third, sustainability reporting and assurance. Next, lean manufacturing principles, followed by lean accounting in action, and finally, executive summary and strategy. Let's get started. Section 1. The corporate longevity crisis, mitigating threats to long-term value. We really need to recognize right out of the gate that sustainability is no longer just some corporate buzzword or a feel-good PR exercise. It is a fundamental survival mechanism. So how do we actually define business sustainability? It's the practice of creating long-term organizational value through internally understanding, measuring, and managing key threats and opportunities to achieve the organization's strategy, and then externally reporting those outcomes. Now, selecting a strategy is usually the CEO's job, right? But implementing it effectively, that requires management to make everyday decisions that actually support, rather than conflict with, long-term survival. You have to quantify the expectations of everyone involved. Section 2. The business sustainability cycle, connecting strategy to performance. So how do we connect top-level strategy to actual on-the-ground performance? Notice how the business sustainability cycle functions as a continuous visual loop. It begins at the top with strategy. From there, management moves into stakeholder engagement. Interacting with investors, customers, regulators, communities, basically exchanging data and expectations. That flows directly into risk management, where those specific stakeholder concerns are treated as actionable risks and opportunities. And that naturally leads to performance measurement, tracking things like future cash flows. Finally, the cycle rounds out with sustainability reporting and assurance, which feeds right back into strategy. It's all connected. Now, what's really interesting about this next concept is the sheer volume of variables in the MSCI ESG universe detailing the environmental, social, and governance pillars. Just look at all these factors. You've got carbon emissions, supply chain labor standards, board diversity, product safety, the list goes on. As a business sustainability consultant, I can tell you for sure that quantifying these stakeholder expectations is exactly what helps management mitigate threats to long-term value. But here's the catch. Because organizations have limited resources, they literally cannot please all key stakeholders all the time. Balancing these conflicting needs remains a core management challenge. Section 3, Sustainability Reporting and Assurance, Building External Trust. Okay, so once you've identified and managed your ESG risks internally, you have to communicate that narrative effectively to build external trust, particularly with your investors. Notice this massive upward trend in corporate sustainability reporting, or CSR, since the 1990s. That top red line represents the top 250 global companies, and they're sitting at a 96% reporting rate by 2020. Why this explosion in voluntary disclosure? Well, because communicating your sustainability story secures highly tangible benefits. We're talking lower borrowing costs, a huge influx of investor capital, attracting much better employees, and securing far more favorable regulatory treatment. It directly improves decision-making for company executives by cleanly tying non-financial data to financial outcomes. And this isn't just some niche trend for specific sectors. It is a global standard. By 2020, widespread adoption hit a full 100% across major sectors, from technology, media, and telecoms to retail and oil and gas. Even financial services and healthcare are right behind them. Across the board, corporate sustainability reporting is simply how modern business is done. But you can't just publish a glossy report and call it a day. You have to back it up.
Here we see the growth in independent assurance of sustainability information climbing to over 71% for the top 250 global companies by 2020. Having these reports verified by an independent third party is absolutely crucial. People are just far more likely to trust qualitative and quantitative CSR information if it's been verified by an unbiased party. It significantly mitigates risk and drastically increases believability for those vital external stakeholders. Section 4. Lean Manufacturing Principles. Eliminating waste on the floor.
So we've covered the macro-level corporate reporting. Now let's pivot to micro-level execution on the factory floor. Because true long-term value isn't just about managing external risks. It's about eliminating operational waste internally. Enter lean manufacturing. It's all about delivering the right product in the right quantity at the exact time the customer needs it at the lowest possible cost. It rests on these 5 principles. First, precisely specify value by each product. Second, identify the value stream, mapping out all processes to eliminate waste. Third, make value flow without interruption. Fourth, let the customer pull value, using a demand pull system so you're producing only what is needed when the customer actually demands it. And fifth, relentlessly pursue perfection. And this brilliantly illustrates the old way of doing things. Look at the glaring red zones in this traditional batch production process. We have 8 minutes of just wait time, then 6 minutes of actual value-added cutting, followed immediately by 9 minutes of non-value-added move and wait time before drilling, then 16 minutes of move and wait time before assembly. It's like a giant traffic jam. Traditional systems group production by function, forcing large batches to move from department to department, just sitting around waiting for their turn. It is highly, highly inefficient. Now, contrast that wait time with a much better solution, the proposed manufacturing cell. Notice the difference here. By grouping the machines, cutting, drilling, assembly, and finishing, in a semicircle really close to one another, we drastically reduce those setup and move times. This specific lean tool is called cellular manufacturing. It creates a continuous value flow, allowing for smaller batches of differing products. It cuts lead time, decreases product cost, and fundamentally increases your ability to respond quickly to customer demand. It's a real game changer. Section 5. Lean Accounting in Action. Tracking True Value Creation. Now, here is where we hit a critical crossroads. If you change your manufacturing floor to be lean and efficient, but you keep traditional standard costing, you will actually distort your product costs and potentially signal financial failure even when things are going great. To prevent this distortion, we must transition to lean accounting. Instead of plant-wide overhead rates, we create focused value streams where overhead costs are directly traceable to the products in that stream. Look at this formula. Value stream product cost equals unit materials cost plus average conversion cost. The absolute critical difference here is that average conversion cost is calculated by dividing total actual conversion costs by the units shipped, not units produced. Think about it. This lean accounting principle directly reduces waste and supports sustainable models by deliberately motivating managers to clear out wasteful inventory. Let's look at a real-world case study to see this in action. The Holland Company Value Stream Box Scorecard. Lean control systems actually replace those traditional standard variance reports with a box scorecard like this, comparing specific operational, capacity, and financial performance measures against a desired future state. Just look at the trends here. Dock-to-dock days are dropping. First-time through quality is rising from 65 to 75%. Non-productive capacity is shrinking. And because of these operational efficiencies, weekly value stream profit is trending significantly up, from $304,000 toward their $625,000 goal. This is exactly how you track true, long-term organizational value creation. Section 6. Executive Summary and Strategy. The Path Forward. So what does this all mean for the C-suite? Well, for senior leaders, managing triple bottom-line success factors, environmental, social, and financial, requires a highly cohesive approach tying all these elements together. Here is your definitive executive summary and checklist. First, identify your risks via rigorous stakeholder engagement. Second, leverage corporate sustainability reporting to secure lower capital costs and build external trust. Third, internally, adopt cellular manufacturing to eliminate operational waste. Fourth, transition to lean accounting to prevent those traditional cost distortions we talked about. And finally, high-level leadership must base strategic resource allocation on true value stream profitability. As we wrap up, I want to leave you with this provocative question as you evaluate your own internal structures. Is your accounting system hiding your greatest risks, or is it illuminating your path to longevity?
Managerial accounting is no longer just about tracking past expenditures. It is literally the compass for your future survival. Thank you so much for joining me for this explainer, and I strongly encourage you to critically examine how your organization is future-proofing itself today.